Hello and welcome from my hotel room. This is our one video to wrap up chapter 14 on the topic of basis. We're going to talk about mostly basis of gift property and inherited property. We'll have a few other things at the end of the video as well. So the basis of assets received as gifts. We'll start with gifts received before 1921. Now, that's over 100 years ago, but it is relevant today. So here it is. It's very simple. The basis, fair market value at date of gift. Trouble with that was that people would say, okay, well, I want to sell this particular asset. How can I get the basis up before I sell it? I know. I'll give it to my spouse and then let my spouse sell it. And the basis will be fair market value at the date I made the gift. So no gain if the spouse turns around and sells it right away. So Congress said, all right, that's not going to work. Starting in 1921, here's the rule, and this is still the rule today. It's the dual basis. If you are recording a gain, then the basis will be whatever the basis was of the giver of the gift. So you can't get a step up in basis simply by giving your property to your spouse or some other family member. But if you're calculating a loss, then it's going to be the lesser of the donor's basis or fair market value at the date of gift. So the basis can go down to fair market value at date of gift, but it cannot go up to that level with the gift. Appreciated assets, here's a little chart. If appreciated means that the value has gone up, so the fair market value is greater than basis. So if this is the day the donor bought it, and this is the date of the gift, the value went up. If that's the case, well then basis is either donor's basis for gain, or the lesser of donor's basis or fair market value at date of gift. Well, that's also donor's basis. So the basis is the donor's basis no matter what happens after the date of the gift. So that's easy. If it's property that has gone up in value so that the basis is less than fair market value at date of gift, then basis is donor's basis, period, you're done. But if it's a depreciated asset, basis is greater than fair market value at date of gift, so the value has gone down. Donor bought it, and then the date of gift is later, and the value has gone down. Well, now it's going to matter what happened to the value after the date of gifts between then and the date of sale. So add the date of sale and say what happened to the value after that. Three basic possibilities. Maybe the value just continued to drop. Or maybe it shot back up and actually got to a point where it was higher than it was back when the donor bought it. Or maybe it came back a little bit but didn't get back to the level it was when the donor bought. Okay, so that is those are the three possibilities for what might have happened. Let's assume, first of all, donor's basis is $7,000. Fair market value at date of gift is $4,000. And so we're going to sell this for, let's do a few different examples. $3,000, and the amount realized is $3,000. Well, that means the value has continued to drop. Started at 7, then we had the gift and it was 4. We couldn't sell it for more than 3. So basis is going to be the lower of those two numbers, which is 4,000, and therefore we have a $1,000 loss. Basis for loss is fair market value at date of gift, and we have a $1,000 loss. What if the price shot way back up past what it was when the donor bought it? So sale price is $9,000, so the value jumped way back up past what it was when the donor acquired it. Now the amount realized, well, that's $9,000, and the basis is going to be basis for gain. Donor's basis of $7,000, so there's our gain, $2,000. What if it's in the middle? Not back to 7,000, but it's more than 4,000. Let's say 6,000. Amount realized, that's 6,000. Basis for, well, let's try basis for gain. That would be 7,000. Nope, that's not going to work. That gives us a loss. Try it again. Let's use basis for loss. 4,000. No, that didn't work either. Gave us a gain. So what do? If the basis for gain results in a loss, and the basis for loss results in a gain, which is what happens when that sale price is in that middle ground there, then no gain or loss is recognized. Call it a tie. So no gain or loss in that case. So if the sale price is 6,000, you don't get to deduct a loss, but you also don't have to recognize a gain. If there was gift tax paid on appreciated property, now this does not apply to depreciated property, only property that went up in value, and you'll see why in a minute. We're going to get to add to basis the amount of the gift tax, multiply it by a fraction. The numerator is fair market value minus donor's basis. So notice that if donor's basis is not less than fair market value, that's going to be a negative number. If donor's basis is greater than fair market value, that's going to be a negative number. So if this is depreciated property, that fraction would be negative. And you just don't make any change to basis in that case. But if the fraction is positive, the denominator there is the taxable amount of the gift. Taxable amount of the gift being the fair market value minus a $19,000 exclusion. The $19,000, that's the 2025 amount. That does change periodically. Okay, so anyway, you can add to basis the amount of gift tax paid times that fraction if that fraction is positive. You don't have to subtract it from basis if it's negative. So it only applies when you have appreciated property. Let's take a look at problem number 42. Roberto has received various gifts over the years and has decided to dispose of several of these assets. What is the recognized gain or loss from each of the following transactions, assuming no federal gift tax was paid when the gifts were made? So no gift tax paid, so no adjustment there. This is just straight gifts, not taxable. 1990, he received land worth $32,000. Donor's adjusted basis was $35,000. Roberto sold the land for $95,000 in 2025. So that is definitely going to be a gain. So amount realized. So the amount realized is, for letter A, $95,000. The basis, $35,000. That is the donor's basis. Since it's basis for gain, it's always going to be donor's basis, even though this is depreciated property slightly. So we have a realized gain of $60,000. Letter B. In 1995, he received stock in Gold Company. Donor's basis was $19,000. Fair market value at date of gift was $34,000. This is appreciated property. Roberto sells the stock for $40,000, so it continued to appreciate. So amount realized, that's the $40,000. The basis is basis for gain, which is $19,000, donor's basis. And so we have a realized gain here of $21,000. Letter C. In 2001, he received land worth $15,000. Donor's basis was $20,000. Roberto sells the land for $9,000 in 2025. So this is depreciated property, dropped from $20,000 down to $15,000 at the time of the gift, and then down to $9,000 at the time of sale. So $9,000 amount realized. Basis for loss. Basis for loss is $15,000, and so there's our loss, $6,000. Letter D. Notice I said D gain, and next we'll have D loss. Obviously, this is going to be one of those middle ground areas there. Okay, so letter D, he received stock worth $30,000. Basis was $42,000, so depreciated property. It dropped in value from $42,000 down to $30,000. And then Roberto sold the stock for $38,000. Rebounded a little bit, but not back to Donor's basis. So that is exactly that middle ground where we already know the answer is going to be amount realized, $38,000. Basis for gain is Donor's basis. That gives us a realized loss of $4,000. Basis for gain gave us a loss. Try it for basis for loss. Amount realized is $38,000. Basis for loss is $30,000. That's going to give us an $8,000 gain. So therefore, no gain or loss is recognized. Now we're going to skip part E of this question, build a spreadsheet. We don't need to do that. So let's go straight to problem 44. Margot receives a gift of real estate with an adjusted basis of $175,000, fair market value of $100,000. So Donor's basis was $175,000 and the fair market value was $100,000. The donor did pay a gift tax of $15,000 on the transfer. If Margot later sells the property for $110,000, what is her recognized gain or loss? Donor's basis, $175,000, that's basis for gain. Fair market value at date of gift, $100,000, that's basis for loss. Her amount realized was $110,000. The basis is basis for loss. Well, that gives us a gain. Basis for gain gives us a loss. And so no gain or loss is going to be realized on this one. And we can ignore that gift tax, because the gift tax only applies if we have appreciated property, and this is not appreciated property. It went down in value by $75,000 from the donor's purchase date to the date of the gift. So basis for gain results in a loss, basis for loss results in a gain. No gain or loss is recognized, and you can ignore the gift tax. Next up, inherited property. Inherited property had the same rule as the pre-1921 gifts, fair market value at the date of transfer. In this case, it was fair market value at date of death. Well, Congress said, okay, now making a gift right before you sell is one thing. Dying right before you sell, that's a bit extreme. They said, we don't need to change that rule. So they said, okay, leave it at basis is fair market value at date of death, but 2010 was a little bit of a different rule, which I'll explain a little bit further later. But the rule for most property received as an inheritance is fair market value at date of death. There is a special rule for property that was received from someone who died in 2010. That's because basis is generally tied to the asset's value for estate tax purposes, and the estate tax was temporarily repealed. It turned out it only was repealed for the year 2010, and then it came back in full force in 2011. It was one of those cases where the party in power said, we're going to make this change, but we're going to make it temporary, and maybe later we'll make it permanent. And by the time the 2010 rolled around, they weren't in power anymore. And the other party said, we don't mind the estate tax. We'll just let that come back in full force. So only 2010 is affected by this rule, because there was no estate tax for people who died in 2010. There is an estate tax for all the people who died before that and all the people who have died since then. Well, the rule for 2010 is essentially decedent's basis. There are adjustments in there. I'm not going to go through the details, you will definitely not see from me a question based on someone who died in 2010. You probably virtually certain not to see one on the CPA exam. And it's not even very likely that you'll have to deal with it in your job because it's been 15 years. So presumably any estate tax filings that were done will have been done. Now, you could have somebody who inherited something in 2010 and now they're just getting around to selling it 20 years, 30 years later. You might have to deal with it. Well, then go look up, okay, just keep in mind, 2010, that's that year. It's the year George Steinbrenner died. So if you have a client who inherited some Yankee stock from George Steinbrenner, this may come into play. Otherwise, I don't think you're going to see it. In some circumstances, the executor of the estate may elect an alternate valuation date. Now, this applies not just to 2010, it applies to all decedents, so you may have to deal with this. Alternate valuation date is 6 months after the date of death. It's not always available. You have to have a drop in value of the estate property to get it, and then you can decide whether to elect it. It's an election, so you don't have to take it. If the alternate valuation date is elected, the basis of the property received is fair market value on the earlier of date the property is distributed or the alternate valuation date, that 6 month date. So those are the possibilities. Just figure out when was the property distributed, was it before or after the 6 month date, and go from there. Problem 48. Dan bought a hotel for $2,600,000 in January of 2021. In May of 25, he died and left the hotel to Ed. They don't give us the day in May. Sometime in May, Dan died and Ed inherited the hotel. While Dan owned the hotel, he deducted $289,000 of cost recovery, depreciation. The fair market value in May of 25 was $2,800,000, so up from the amount when Dan bought it. Fair market value 6 months after that, $2,850,000. Assume that an estate tax return, Form 706, is not required to be filed, which means that the executor of the estate did not have even an opportunity to elect the alternate valuation date. So letter A, what is the basis of the property to Ed? Basis of the property to Ed is going to be fair market value in May of 2025, which is $2,800,000. Letter B. What is the basis of the property to Ed if the fair market value 6 months later was $2,500,000 rather than $2,850,000, and the objective of the executor is to minimize the estate tax liability? In that case, assuming that 706 is filed, if you don't file 706, you can't elect the alternate valuation date. There's no form to elect it on. But if it is filed, then use the fair market value at November of 2025, right around now, which would be $2,500,000. So that is going to be the basis in that case, if the election was made. Presumably it would be if the executor is trying to reduce the estate tax, drop the value of the hotel among the other assets that Dan had, then you're going to make that election. We would think. We need to know what the rest of the estate looks like. Sale of assets to related parties. So this is a little bit different because now you have not gifts, not transfers through an inheritance, but a straight sale. But there is a special rule if you sell to a related party. If there's a loss on the sale, it is disallowed because you are not selling it at an arm's length transaction. You're selling it to someone who qualifies as a related party. So no loss allowed. If the related party sells at a gain, then that subsequent gain recognized by the related party may be reduced by the amount of the disallowed loss that the seller, the original seller, had. Who's a related party? Family members of the seller, and the list is fairly short. Anybody who is an ancestor, so mother or father, grandmother, grandfather, etc., or anyone who is a descendant, child, grandchild, great-grandchild, etc., as well as siblings and also spouses. And that's pretty much it. So anyone more distant than that doesn't count as a family member. Partnerships in which the seller is a partner. So if you sell the property to your partnership, that would be a sale to a related party. Or corporations in which the seller is a more than 50% stockholder. That also is a sale to a related party. So let's take a look at problem number 51. Lewis owns 3 pieces of land with an adjusted basis as follows. Parcel A, $75,000. Parcel B, $125,000. Parcel C, $175,000. Lewis sells parcel A to his uncle for $50,000. Parcel B to his partner for $120,000. Parcel C to his mother for $150,000. What is the recognized gain or loss from the sale of each parcel? First of all, letter A, amount realized. For parcel A, $50,000. The basis, $75,000. So we have a realized loss of $20,000. That's for the sale to the uncle. The recognized loss is going to be $25,000. Uncle does not count as a related party. Siblings do, and ancestors do, but the sibling of your ancestor, in other words, your mother or father's brother, that's your uncle, does not count as a related party. So you can recognize that $25,000 loss. Parcel B, $120,000 amount realized, basis $125,000, so there's a $5,000 loss. That's the sale to the partner. That's also a recognizable loss because a partner is not a related party. The partnership would have been, but not the partner. And parcel C, that's the sale to mom. Amount realized $150,000, basis was $175,000. That's a $25,000 loss, and mom is a related party, so no recognized loss there. So that is part A of this question. Part B, C, and D. Part B, Lewis' uncle eventually sells the land for $90,000. Part C, Lewis's partner eventually sells the land for $130,000. Part D, Lewis's mother eventually sells her land for $165,000. And the question for all 3 of these is, what is the recognized gain or loss on the subsequent sale by the person who bought it from Lewis? And the answer is, for B, that's the uncle's sale. Amount realized $90,000. Basis is $50,000, what uncle paid Lewis. So that is a realized gain of $40,000, and that's it. Recognized gain is that $40,000. There's no adjustment because there's no unrecognized loss to bring over there. Question C was the sale by the partner. Amount realized $130,000. Basis $120,000. So there's a gain of $10,000. Once again, no deferred loss to use there, so $10,000 it is. And finally, mom sells for $165,000. Her basis was what she paid for it, $150,000. So that is a $15,000 gain. Lewis had an unrecognized $25,000 loss. So mom can use that $25,000 loss to eliminate her gain down to zero. She cannot deduct the other $10,000 as a leftover loss. Nope, sorry. You can bring your gain down to zero, but that's it. The rest of that $10,000 loss is just gone. No one gets the benefit from that. Next up, wash sales. Wash sale rule is when you buy something and then sell it, and then within 30 days, you turn around and buy it again. So a wash sale is a sale of an asset accompanied by a purchase of an identical asset within 30 days before or after the sale. They were originally thinking if you buy it and then sell it on Tuesday and then go back and buy it back on Friday or even a week from Tuesday, that would be a wash sale because you sold it and then turned around and bought it right back. Then they said, well, you know what? You could also actually, if you knew you were going to do that, you could buy first and then do the sale. So they said, okay, 30 days on either side of the sale, either before or after. Although the typical thing is you sell and then say, oh, I shouldn't have sold that. That's about to go up in value, and you go back and buy it back. That is a wash sale. And the rule for a wash sale for that 61-day window is any loss realized is disallowed. If you have a gain on a wash sale, no problem. But if it's a loss, we're going to disallow that loss. But we will let you add that loss to the basis of the purchased asset. So then when you turn around and sell the purchased asset, win or lose, you have an increased basis. So you're essentially deferring the recognition of the loss. You don't get to deduct it on the original sale, but you can add that to the basis of the property so it is not lost forever. Problem number 53. December 28th, 2025, Kramer sold 150 shares of Lavender Inc. stock for $77,000. On January 10th of 2026, he purchased 100 shares of the same stock for $82,000. So notice he sold 150 shares and then bought back only 2/3 of that, 100 shares. So assuming that Kramer's adjusted basis for the stock sold is $65,000, what is his recognized gain or loss? What is his basis in the new shares? So his amount realized is, in letter A, $77,000. Basis was $65,000. So he had a gain. Therefore, recognized gain, $12,000. Wash sale rules only apply to losses. Basis of the new shares is, well, what'd you pay for it? $82,000. Letter B. Assuming Kramer's adjusted basis for the stock sold is $89,000. Now, what is his recognized gain or loss, and what is the basis of the new shares? $77,000 amount realized, but now we're assuming the basis was $89,000. So it wasn't a $12,000 gain, it was a $12,000 loss. Recognized loss will be $4,000. Remember, the deferred loss only applies to the 100 shares that were bought back. And he sold 150 shares, so you can recognize the $4,000 loss on the 50 shares that were not part of the wash sale, that he didn't buy back 150 shares, he only bought back 100. So the basis of the new shares, $90,000. That's going to be what he paid for it plus the other $8,000. So 82 plus 8 is 90. Letter C. Letter C says, advise Kramer how he can avoid any negative tax consequences encountered in Part B. Well, you know what? They're not all that negative. What happened? Well, he had to defer recognition of the loss. Now, he has to actually defer it a whole year because it was December of 25. He can't take that loss in 25. He's going to have to wait until 26 to get the tax benefit of that. The basis of the new shares, obviously, if he sells them in 26, that basis will be $90,000, so he gets the benefit there. But it is actually a 1-year lag because it happened right around the first of the year. So if you want to advise Kramer to avoid that, then you say, wait. Don't buy those new shares, that 100 new shares that you bought. If you wait until January 28th, that is 31 days after the sale date, and so therefore you're fine. No wash sale rules apply. You can deduct the full $12,000 loss in 2025. And that is it. That is our unexpected video for the basis from gift property, inherited property, as well as a couple of rules toward the end of chapter 14. So on Thursday, I will be back at Oswego, and we will pick up with chapter 15. See you then.